Welcome back to Real Estate Radio TV, the commercial real estate focused media, for a new interview. In today's interview, we have the great honor to welcome Faris Najjar and Marc Nakhoul, partners at LMF CAPITAL, a Swiss-based real estate investment consulting firm focusing on pan-European equity and debt services. In today's interview, we are going to discuss many different topics, including credit advisory becoming predominant over the past couple of years, and how can investors leverage the services to optimize their capital structure, the current debt market and outlook in the European sector, latest news on Credit Suisse and its impact on commercial real estate debt transaction, overall thoughts on the market, its momentum, and the different sectors within commercial real estate. Faris and Marc, how are you guys doing today?
Excellent, thank you. What about yourself?
Thank you.
It's a pleasure to have you guys on. So before we dive in and talk about the great topics we've planned for today's interview, I want you guys to introduce yourselves, talk a bit about LMF CAPITAL, the type of services you offer, the markets you cover, as well as your track record.
Yeah, sure. Thank you for having us today. It's a pleasure to be here. For LMF CAPITAL, it's a management-owned company based in Zug, Switzerland. And we are also present in Frankfurt, in Germany, as well as in Prague, in the Czech Republic, where I am mostly based. LMF Capital is an advisory boutique specialized in debt, real estate, and equity. Let's say 80% of our turnover and transactions are on the debt side. So basically, we help sponsors, asset managers, family offices, or financial institutions investing in Europe into real estate, into the real estate sector. We help them to source debt for the either acquisition or refinancing, or for example, the renovation or redevelopment of the project. We are, as LMF Capital, we work on different asset classes within the real estate sector. We are sector agnostic. We worked on logistics projects. We did retail, offices, residential, healthcare, and even schools. In terms of geography, we are pan-European. We can cover all the markets. That's why we have 3 offices, and hopefully maybe more in the future, so we can do from Portugal west up to the Czech Republic east, and north to south from the UK, Nordics, maybe a bit of Scandinavia down to Italy. That's in a nutshell what we do. It's very important to mention that we are multilingual, so we speak 6 languages within the firm. This is very important to mention, as this helps us to be very local and to play and to work with local players within different markets. Now, in relation to our latest transactions, I will let my colleague Marc to give you like a small overview of what we did as transactions for this year and last year.
Great. So thank you for having us. So I am Marc Nakhoul, partner at LMF. I'm based in Frankfurt, Germany. And as Faris mentioned, we are a pan-European credit advisory boutique. At least this is our bread and butter in terms of advisory. So in terms of credit transactions, which we advised on and we sourced on, we worked on hospitality assets in the Iberian market. We understand this market attracts a lot of international lenders, especially in terms of the whatever is hospitality, and currently whatever is linked to living, well, let's say student housing or senior living as well. We as well worked on logistic transactions. The logistic market has been tilting towards value add since around 1 year because the core logistic opportunities dried up during COVID. A lot of opportunities on the core side during COVID has been scooped by big institutional funds, and a lot of logistic asset managers who had a lot of firepower moved towards the value add playground. So in the French market, for example, we worked with a US logistics specialist on financing a speculative development close to Paris in Marolles-sur-Seine. We also worked on a very, very important transaction at the port of Le Havre, where there was a freehold plot that housed 4 warehouses, and this transaction was very complicated in terms of the timing, in terms of also in terms of the acquisition itself, because the vendor group was mixed and was phased in terms of timing. So what we've done here is we worked on a tranche A, tranche B, tranche C with the same lender. We had to be very creative on the structure. We had to create a midco, and at the same time keep costs low, because if we want to do a loan documentation for each transaction, this would be a costly transaction as well. So this is on the value add side. This was in the French market. In the German market, we worked, for example, on junior loans, one in close to Munich on a light industrial new build property, and another one close to Leipzig on a portfolio of offices and retail assets. As mentioned by Faris, we are multilingual and we cover very well the market on a pan-European level. Most of the time, it would be marrying or bringing lenders from outside the network of sponsors. And also most of the time, these would be complex transactions that really need an advisor to be able to bring the financing and put it in place. So this is in a nutshell on LMF.
Capital markets is really at the top of every discussion and conversation in commercial real estate, at least. I want to get your thought, guys, on what added value can credit advisory bring in complicated capital environments like we're seeing today.
Yeah, yes, that's a very valid question, because a lot of people ask us the same question: what is our added value, either today or even in general? So working with that credit advisor is nowadays even more important than before, because let's take the example that you are a project owner and you need debt financing. You might have some contacts in the market, 1, 2, 3, 4, maybe more banks, or even private debt funds. But who can assure you today that you are getting through your network the best offer in the market? So the best solution here, which I recommend you as project owners, to go to a credit advisor like LMF CAPITAL or others, and let those people work for you. We as LMF CAPITAL, we are on a daily basis in contact with debt providers. We participate in every single exhibition in Europe, MIPIM, of course, Expo Real, other exhibition in Provada in Netherlands, in Amsterdam, and many others. So we have a network of 80 plus private debt lenders or traditional lenders. So when you come to us with a project, first we help you to organize it and to make it appealing to the lenders, because we know very well what they want to see, what they don't want to see. And then we go and reach our network and we make sure to get you the best offer on the market. So in order to optimize your project and to get the best that you have that you can find in the market, the only way is to give it to an advisor like us. Plus, of course, our added value as an LMF CAPITAL is that we are, we insist on by saying that we are multilingual, which means that we have a very strong reach within the market with local players, either in Europe, as you know, in Europe to the opposite of the US. Europe is a big continent with different languages, different culture within the same area. So it's very important to have this knowledge of those local areas in order to get access to liquidity and to debt financing, and this will only play in the advantage of the sponsor. That's what I see as the main reason why a credit advisor is important. Maybe my colleague Marc has other arguments that he would like to mention.
Yeah, sure. So actually, especially this year, we are seeing a lot of transactions where a credit advisor is actually of great importance, because banks cannot increase their leverage beginning this year. There's this debt yield threshold that they are limited to, and this, when you do a reverse formula on the debt sizing, beginning with the debt yield, they end up with a 50%, 45% LTV, while when we had liquid markets in the German markets, let's say French markets, even in the Netherlands, banks could have financed easily in the past years up to 60 or even 65%. Currently, they are at 50. This is not enough in terms of leverage for a lot of sponsors, even highly institutional sponsors. Some of them might have in their fund prospectus a limitation of 50% LTV. This is something. This means these funds or these institutional managers are not affected by today's market situations. However, a lot of them used to seek 65% LTV, and this is actually where we as credit advisors are working a lot on blended solutions, senior, junior, blended structures, where we bring a senior lender and a junior lender who can do an intercreditor agreement between each other, and they can actually provide a blended margin that is still very, let's say, attractive to sponsors who seek 65 and sometimes even 70% leverage. And this can only happen through a credit advisor who can line up the senior lenders, who can line up the junior lenders, and based on history, some of these lenders on the senior and junior side might have worked together in the past, which might be an easy operation, and maybe sometimes they have never worked in the past, but currently the situation fits them both. And this is where we work on a lot of provisions, a lot of conditions on the ICA just before going back to the sponsor and saying this is the best solution for you. So now there's a lot of more work to be done because it's getting complicated, but it's getting very exciting for credit advisory.
And the type of lenders you mostly work with, is it what, insurance group, alternative financing, debt fund? What's the majority type of the lenders you usually work with?
Yeah, so we work with banks, the traditional lenders, we call them. And then the second bucket on the core side, core plus side, can be insurer groups, asset managers for insurers. And then the third bucket would be asset managers on the private debt side. These would be running pension fund money or even running sovereign wealth fund money. Or have collected funds from the general market. Within private debt funds, you have the core funds, you have the value add lenders, and let's call them the mezzanine lenders at the top of the scale. So we are connected to all this sphere. And sometimes based on the project or based on the asset or the portfolio's risk return metrics, we choose which pool to attack, which pool from these. Let's say we have a pool of 4 or 5 categories, which pool to attack from our side. And sometimes, as I mentioned before, we try to marry funds and lenders from different pools altogether. Yes, but as mentioned by Faris at the beginning, we have more than 80 plus credit funds in our network from Asian, European, Anglo-Saxon, American, Canadian funds who operate on the pan-European level.
The debt market has changed quite a bit, at least its landscape over the past couple of years. I would say since post-financial crisis, we've seen banks, being less flexible in the way they lend. We've seen the growing momentum for alternative financing, alternative lenders. I want to get your thought, guys, on what are the main changes that you're seeing in terms of the scope of credit advisory since those past couple of years.
Yeah, so as mentioned in our track record, we had more value add work than core plus work. So when we started LMF, we used to receive more solicitations to help or support asset managers on speculative financing, on value add projects, on projects that have different risks in terms of authorizations and planning and so forth. And actually, beginning this year, and let's say beginning Q4 of last year, we're seeing that we're receiving more opportunities that can be categorized as core plus or core opportunities, where you have only rent roll risk, rollover risks in the rent roll, or you have, let's say, weak credit covenants in the rent roll. Usually, these mostly were tackled by traditional lenders, and now, as a lot of them have retreated, we are getting, as credit advisory, more work on the core plus side, especially this year.
And you mentioned you work on several types of lending, from junior, senior, mezz loans, but you also work on pref equity, because it's something that really combines debt and equity at the same time, something very popular in the US to sometimes achieve better risk-adjusted returns.
Pref equity can be a solution for projects like, for example, residential, where you have, for example, an important micro location for a certain project, but still the project's risks can be identified as equity risk when you have, for example, planning risk or permitting risks, but still, if the project goes on and actually get all these authorizations, the delta or the volatility of the returns actually is let's call it binary. Sometimes the returns can be very high for such project. So sometimes some asset managers come to us and say, look guys, we need like senior debt or transitory debt, let's call it a bridge financing. And then when we sign an NDA and look at the project before we go to market, usually this is what we do. So before going to market, we really analyze the project over 1-2 weeks with the sponsor, and we tell the sponsor, this is not debt risk, this is equity risk. And here you might need, if you're open, we can bring you pref equity. Or a hybrid mezz, we call it, where there is like a fixed return for the lender and the IRR based return that is like a variable component to the fixed return. And as I mentioned, these mostly are on flagship projects, mainly on residential, because there is a big binary event here. And these kind of risks are mostly equity at stages of the financing, of the solicitation of financing. But let's say pref equity, beyond that, it's still something that a lot of asset managers try to avoid. The market was very liquid 2-3 years ago, and mezzanine financing, which is an alternative to pref equity, in Europe was very much liquid, very much active. Some sponsors in the DACH region, for example, in Germany, in Austria, used to get 90% LTC to their projects, and they didn't have to have recourse for pref equity or any kind of equity-linked debt instruments. They used to get a mezzanine, let's say, under a fixed structure, which was working well for them. Now the market has moved. Even mezz has receded. It has retreated. LTC levels, LTV levels, even on the junior and the mezzanine side, let's say, are much more currently conservative. Even we have seen that some institutional investors who used to do junior debt pieces have stopped recently. So pref equity might come back, and especially with developers who find it difficult to keep their balance sheets sustainable due to high leverages taken during the last 2-3 years, and currently they cannot find good exits for these projects, so they might refinance at the level of holding companies through pref equity.
Okay, so really credit advisory is basically a 3-step process. First step is really looking at the project in itself, its potential. Second step, really looking at optimizing the capital structure with really using the right combination of debt to both from the lender perspective and also for the equity investors to achieve the best risk-adjusted returns, and then going ahead with the full package marketing to lenders. Is that the overall process?
Correct. We don't call it marketing. We call
of course.
We call it, let's say, advisory. And we, as a boutique, we are more boutique-ish in terms of when we go to market than other bulge, let's call them large consultancies or large advisories. As a boutique advisory, we are much more targeted. So when we understand the project and we get an engagement letter executed with the sponsor, we are very, very targeted. Usually we can be soliciting between 5 to 10 lenders within each category of where we want them to sit in the capital stack, not more. Usually there is in the industry, there's a long list and a short list. We try to avoid the long list, and we try to always go to the short list. And to do so, you have to have a more of a boutique-ish style of approach, or let's say, or a boutique-ish approach when we tackle the market. And this is actually very well appreciated by a lot of sponsors who sometimes don't want to have a big processes, and they also try to avoid if these kind of big processes don't result in positive feedback. This can affect their the value of their projects or of their balance sheets. It's not good as well reputationally in the market when they work with counterparties, with other stakeholders who look for guarantees and other kind of provisions when dealing with these asset managers. So having a boutique who would do the credit advisory is actually serves the best interest of these sponsors.
Like you mentioned at the introduction of the interview, LMF Capital is really operating on a pan-European basis. You mentioned Poland, Germany, France, Iberian Peninsula, but the company is based in Switzerland. Switzerland is a country we've heard quite a bit over this past couple of weeks, at least in financial market with the Credit Suisse news. So I want to get your thoughts on whether or not did you see a recent impact on overall debt transaction in Europe after the headline of the Credit Suisse news?
Yeah, absolutely. And I know you were in MIPIM, and the Credit Suisse story started really to have a big impact during MIPIM. So everybody, if you notice, we're talking about it. So, absolutely, the Credit Suisse news, the negative news, had a negative impact on the market. We work on several deals at the moment, so we are in a very good position to give you the feedback of the situation. So basically, when you have a crisis, there is uncertainty, and people, like lenders, are more and more cautious of the situation because they are afraid of the valuations. They are afraid of what's going to happen in the future with the global markets. So the normal reaction to those lenders are exactly like a reaction of any other human beings in normal life. When you have negative news, you start to be cautious and to be afraid, and you wait till the situation improves or not. but you prefer to go in a standby situation and to see what's going to happen. And this is exactly what's happening today with the lenders. Some of the lenders that we know were in a position to lend before the weekend of the Credit Suisse. After that weekend, some lenders went into the standby mode. They prefer to wait to see what's going to happen. It's exactly as a human being behavior. You prefer to wait and then take a decision. But on the other hand, it's also interesting to see that also the sponsors or the asset owners that had a very high expectations in terms of leverage or margins before this weekend or before this crisis, they also after this weekend accepted to be more reasonable, or let's say accept lower leverage and lower terms or higher margins. So the market adjusts itself. From one side, the lenders are a bit more conservative, and on the other side, the sponsors accepts it. Now, with time, if we don't see any big impact on the financial markets, and let's say if the situation stabilizes, the debt providers will come back to the market. They will start providing debt exactly as before, and in the same time, the sponsors will start to put their expectation higher. So there is a balance between both. Even if there is a crisis, business will continue. Debt advisory will continue even more. But it's like the expectations of the sponsor changes. In the same time, the expectations of the lenders will change. So there is a balance. And I will maybe give the microphone to Marc, that he can give you other examples of what we have seen last week.
Yeah, so in terms of capital stack, the feedback loop is a bit different. So the 81 bonds of Credit Suisse, and these 81 bonds, there is an understanding in the European Union that these 81 bonds would have supersede. Let's say the equity should be subordinated to 81 bonds. What happened in the Swiss market? There was a different understanding by FINMA, and actually these 81 bonds were wiped and equity stayed in the deal. And so what happened on the debt markets in terms of this is the implication on whatever is junior or mezzanine financings. The financings that are not in the first rank, not having a strong collateral. These kind of loose end financings, mezz, junior, on the institutional side were impacted. Their pricing increased up even further, and also some lenders who used to do junior stopped to do junior because of the impact of these subordinated debt instruments to senior lenders. At the same time, the 81, a lot of banks used to issue 81 bonds to finance their operations. They used to issue these bonds at 7 to 9%. Now they need to, if they want to tackle this market to get financed or to get some short-term financings, they need to issue them at 12, 15, and even more. And so even core lenders or senior lenders increased a bit their cost of capital when they are providing financings for assets or for acquisitions financing, for refinancings. So they increased a bit their margins because their cost of funds, they have increased, or they anticipate that their cost of funds will increase due to the issue with the 81 bonds coming from the UBS Credit Suisse merger. So the impact has been different, more on the junior mezz side than the senior. Senior are adjusting their margins a bit up for their cost of funding. But on the junior side, we're seeing some lenders who have completely stopped doing junior lending as well due to this event in the market.
I mean, we've been through a lot of headwinds those past couple of months, and now the Credit Suisse news and some U.S. banks just, complicate a little bit financial markets. And on the equity side, we've seen valuation going down, at least in the U.S. In Europe, it's picking up. There's general consensus that we're going to see valuation going further down, really putting some pressure on some covenants. Do you believe that we're going to be in a stage in the next couple of months where we're going to see some distress opportunities coming into market? I mean, what's your play on it?
We are starting to see this stress in developers' balance sheets. That's for sure. Especially developers who leverage a little bit more than usual during the last 2-3 years, and they are seeing some illiquidity on exits for certain assets. So this stress started to pick up on the developer side. In terms of fire sales for let's say core assets, well located, which have as well a good credit governance, I think this is not going to be an issue. There will be no distress, let's say, on whatever assets are in the center of cities. So the focus currently is on going inside the cities, going inside the top cities. So if let's say if we have taking an example of secondary locations or micro locations outside London, I would assume these assets are more in a difficult situation in terms of valuations, in terms of breach of governance, than assets inside London, which are on the value add side. So even value add projects within the inner cities of let's say top cities, these are in better situation than core assets on the secondary or tertiary location. And because these markets tend to get illiquid, usually, for example, international investors, we take an example of the UK real estate market. International investors who were seeking a bit of yield, they were trying to go outside the cities on the outskirts, or to go to secondary locations, and used to get high yields on core assets, and they used to also get this through leveraging, through financing. Now, when they want to exit these secondary locations, because the debt market is not very accretive now, in terms of when you use leverage, would equity IRR increase? A lot of situations, this is not the situation. This is not what the result. So these secondary locations tend to get illiquid, and this is where you will get more of the feeling of distress, whether in a refinancing or whether in a fire sale situation. We will not call it fire sale, but for sure an investor who would be in a situation to sell. They would seek to sell maybe at a 10, 20, even 25% price than what was the situation 2 years ago. So let's say secondary locations, tertiary locations are more prone to have a lot of stress on valuations, and also developers' balance sheets have as well have shown and a lot of stress as well, and they are prone to get some private equity financing now.
Like we always say, the key of real estate is really the location. Now switching gears, really, I want you guys, before to let you go, to understand your overall thoughts on the markets. You're involved across various sectors. You mentioned residential, student housing. So really, over the past couple of years, a lot of changes were made in the way people work, live, shop, in the way we live. So really, what are your thoughts on the sectors that currently have the strongest fundamental, real constraint of supply, high rental growth? I mean, what's your take on it?
Yeah, sure. So during COVID, for example, the darlings of the market were logistics, and let's say offices in strong micro locations with strong credit covenants. These were the darlings of the markets during COVID. This has changed. So logistics is no more the darling of the market, while retail and let's call it also hospitality, which might have a good inflation sensitivity, meaning, for example, in some hospitality assets, when a asset owner is incurring a strong inflationary pressures on the cost, they might be able in a situation to actually pass these costs through their ADRs to customers. And actually, this is bringing back some sectors which were hated, for example, like hospitality in strong micro locations, for example, or hospitality that are themed, that have good themes behind them, or even retail. We're not talking about shopping malls, but we're talking about like open area, let's say do it yourself, or other kind of open areas, retail activities, and these actually might be also coming back to the market. So actually, hospitality, retail were cancelled, let's say, by traditional lenders, and they might be coming back because of their positive inflationary sensitivity. While offices currently, a lot of banks, a lot of lenders don't want to do offices, even in very, very strong locations. So offices are weak, and logistics is no longer the darling of the market. So we are seeing this switch. Also, as usual, whatever is living, meaning living like senior living, student housing, short-term residential, this sector, we say, whether during COVID or today, the living sector is showing that it's steady and is not prone to volatility, and it's going up but slowly. And we can call it the most stable currently subsector.
Yeah, also a sector that is very niche, but we're seeing a lot since few years are the education sector, especially schools, with some tenants. Yeah, schools or universities with some private equity owned tenants with long leases. This is a very niche sector, but we receive a lot of requests from some of our clients that are looking to acquire, and they need some acquisition financing. So yeah, the good thing about our business as an advisory is that we receive a lot of requests.
Right.
Some of them are a bit out of the box, very niche. And but from our side, the more the deal is complicated, the more we can perform, because if the deal is very easy or in a sector that is very sexy for everyone, then getting a financing wouldn't be very difficult. But the more the deal is complicated, the more the sponsor would need us. And thanks to our, let's say, good reputation in the market and our strong reactivity, we are building good relationship with our existing clients, and we are sometimes considered like an extension to the financial team.
No, I mean, like you mentioned, advisory firms and consulting firms in general really have a unique perspective on the market, whether it be commercial or other markets. That allows you to sense the market in ways that maybe some investors are not able to do, and that's really where you can add tremendous value.
Exactly.
Well, thank you guys for coming in, Faris and Marc. It's been a great pleasure. We will put your different links in the bio, so if people are ever interested to learn more about your services or just want to reach out a different question, they're more welcome to do so. In the meantime, guys, you can download our app. That's free and available both on the App Store and Android. Follow us on all social media platforms and wait until the next episode comes out. Thank you, guys, and have a great day.
Have a nice day.
Thank you.